Today I am going to introduce 10 monopoly stocks from 10 sectors. We received great response for part 1 of this video, Best Monopoly Stocks to Buy. If you haven't already watched the video, check out part 1 also. Monopoly stocks can provide investors with potentially higher returns and greater stability in their portfolios. These stocks have limited or no competition. If you are new to my channel, please do subscribe. Also check out my playlist, Best Stocks to Buy for the Long Term. So let's get started. The first stock from our list is from the consumer wellness sector. This stock holds 60% market share in sugar-free products. I am talking about Zydus Wellness. They operate as an integrated consumer company which covers the entire value chain, from development to distribution, in the health and wellness sector. Zydus Wellness boasts a diverse range of brands, including the famous Glucon-D and Complan. The company also offers a range of skincare products under the brand name of Everyth Naturals. Zydus Wellness dominates, with Glucon-D holding a remarkable 60% market share. Zydus Wellness has a global footprint in over 25 countries. The top 5 markets contribute to about 80% of their business, with sugar-free franchise and Complan being major players, constituting around 90% of the overall international business. Let's do a basic financial overview. Zydus Wellness, with a market capitalization of 9,877 crores, operates with a current stock price of 1,552 rupees. Price to earning ratio is 35.11, lower than its sector pay ratio of 71.26. Stock price fell 3.82% and underperformed its sector by 13.16% in the past year. Debt to equity ratio of 0.06 is less than 1 and healthy. Promoter shareholding increased by 1.44% in the most recent quarter to 68.54% with zero pledges. Let's discuss the strengths and weaknesses of the company. The company's valuation appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it is a good time to consider the stock as it is not in the overbought zone. Highlighting positive aspects, the company has demonstrated consistent sales growth over the last 8 quarters, achieving a high trendline durability score and maintaining low debt levels. However, it falls short in terms of the Piotrowski score and positive net cash flow. Peer comparison highlights the company's better long-term returns than the industry. Both API and DIIs are actively buying the stock. Additionally, the stock does not fall within the buy zone based on historical PE or PBV, and the valuation score does not signal overall affordability. The second stock from our list is from the power sector. This stock holds 94.2% market share in its sector. I am talking about Indian Energy Exchange. Established in 2007, IEX has played a crucial role in transforming the landscape of the power market in India. IEX is the first power exchange in India, licensed by the Central Electricity Regulatory Commission (CERC) for spot trading in electricity. The platform provides an automated infrastructure for trading in electricity units for physical delivery. This not only enhances the efficiency of trade execution but also fosters transparency in the power market. IEX boasts an extensive network with over 7,300 registered participants from 36 states and union territories. IEX operates in various product segments such as the Day-Ahead Market, DAM, Green Day-Ahead Market, Term Ahead Market, TAM, Renewable Energy Certificates, REC, and Energy Saving Certificates, ESCerts. IEX launched the Indian Gas Exchange, IGX, the country's first automated national-level trading platform for natural gas. IEX's revenue breakup consisted of approximately 89% from operations and 11% from other sources. Let's do a basic financial overview. Indian Energy Exchange, with a market capitalization of 12,733 crores, operates with a current stock price of 143 rupees. Price to earning ratio is 38.81, higher than its sector pay ratio of 24.58. Stock price fell 3.48% and underperformed its sector by 30.96% in the past year. Debt to equity ratio is 0 as the company is debt-free. No promoter holding for the company. Let's discuss the strengths and weaknesses of the company. The company's valuation appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it is a good time to consider the stock as it is not in the overbought zone. The company has not experienced consistent profit or sales growth over the last 8 quarters. Additionally, it does not boast a high trendline durability score or a high Piotrowski score. However, on a positive note, the company maintains low debt levels and a strong return on equity. Nevertheless, the company does not currently exhibit positive net cash flow, and its cash from operations has not been consistently increasing. Peer comparison highlights the company does not outperform the industry in terms of long-term returns. Both API, and DIIs are actively buying the stock. Additionally, the stock does not fall within the buy zone based on historical PE or PBV, and the valuation score does not signal overall affordability. The third stock from our list is from the metal sector. This stock holds more than 50% market share in stainless steel in India. I am talking about Jindal Stainless Limited. This company is the largest manufacturer of stainless steel in India. The company boasts an impressive portfolio of steel grades catering to various industries. Their comprehensive product range comprises ferroalloys, steel slabs, hot-rolled coils, cold-rolled coils, and steel plates, strategically positioned to serve critical sectors including architecture, building and construction, automobile and transport, railways, consumer durables, and the process industry. Taking a look at their geographical presence, a significant 78% of their operations are within India, with the remaining 22% contributing from international markets. Jindal Stainless has a strong global footprint with 14 international sales offices and a manufacturing facility in Indonesia. Its major export markets include Europe, Southeast Asia, and the Middle East. JSL has strategically partnered with Maersk to optimize containerized exports and imports. This collaboration ensures an uninterrupted flow of materials between Jajpur and Vinod Container Terminal. Let's do a basic financial overview. Jindal Stainless, with a market capitalization of 42,525 crores, operates with a current stock price of 517 rupees. Price to earning ratio is 16.38, lower than its sector pay ratio of 18.71. Stock price rose 193.14% and outperformed its sector by 141.86% in the past year. Debt to equity ratio of 0.32 is less than 1 and healthy. Promoter shareholding is at 57.94%. Recent news suggests promoter pledges have reduced to zero. Let's discuss the strengths and weaknesses of the company. The company's valuation appears to be overvalued compared to the market average. However, the current price is less than its intrinsic value. It seems to be a good time to consider investing as the stock is not in the overbought zone. Over the last 8 quarters, the company has demonstrated consistent sales growth, accompanied by a high trendline durability score, a high Piotrowski score, and low debt. Shareholder value is supported by a strong return on equity, ROE, positive net cash flow, and increasing cash generation from operations. Furthermore, institutional investors, API or DIIs, are actively buying the stock, and the company outperforms the industry in delivering better long-term returns. However, the stock is not currently in the buy zone based on its historical price earnings, PE, or price book value, PBV. Nevertheless, the company's overall valuation score signals that it is still considered affordable. The fourth stock from our list is from the auto ancillary sector. Established in 1985, this company is the largest AC company in India. I am talking about Subros Limited. Union Road Transport Minister Nitin Gadkari announced that all trucks would now need to have air-conditioned driver compartments starting 2025. So, this stock Subros Limited will benefit the most. Subros is the largest air conditioning thermal products company in India, boosting a remarkable 40% and 51% market share in the passenger car AC and truck aircon blower segments, respectively. Whether it's for cars, buses, refrigeration vehicles, railways, home ACs, tractors, or trucks, Subros has got it covered. Almost 100% of its revenue in FY22 came from the Indian market, showcasing its strong presence and influence domestically. Subros has a diverse clientele, including big names like Maruti Suzuki India Limited, Tata Motors Limited, Mahindra Limited, Renault Nissan Automotive India PVT Ltd, and Force Motors Limited. The company's manufacturing plants are strategically located in Noida, Manesar, Pune, Karsanpura, Chennai, and Nalagarh. The company is aligning with the Make in India movement, focusing on design in India and manufacturing in India, with a localization level exceeding 80% in all products. Subros is currently focusing on the development and launch of EV and hybrid vehicle products, positioning itself at the forefront of automotive advancements. Let's do a basic financial overview. Subros, with a market capitalization of 2,811 crores, operates with a current stock price of 431 rupees. Price to earning ratio is 42.05, higher than its sector pay ratio of 35.06. Stock price rose 45.15% and outperformed its sector by 3.26% in the past year. Debt to equity ratio of 0.02 is less than 1 and healthy. Return on equity, ROE, for the last financial year was low at 5.52%. Promoter shareholding is at 36.79% with zero promoter pledges. Let's discuss the strengths and weaknesses of the company. In terms of valuation, the company appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it might be a good time to consider the stock as it is not in the overbought zone. The company has demonstrated consistent profit growth over the last 8 quarters. While the sales growth has not been as consistent, the company boasts a high trendline durability score and a high Piotrowski score, indicating financial strength and operational excellence. Additionally, the company has low debt and is generating increasing cash from operations. Despite a lack of positive indicators for shareholder value, such as a strong ROE or positive net cash flow, institutional investors, FII, or DIIs, are actively buying the stock. Furthermore, the company's sales growth outperforms the industry median, and its profit growth surpasses the industry median. However, it falls short in terms of long-term returns compared to the industry. Although the stock is not currently in the buy zone based on historical PE and PBV, the overall valuation score signals that it remains relatively affordable. The fifth stock from our list is from the e-commerce sector. This stock is India's largest online marketplace that assists manufacturers, suppliers, exporters to trade with each other. I am talking about IndiaMart Intermesh Limited. This company is the first and largest retail marketplace in India. IndiaMart's business primarily comes from small and medium enterprises. IndiaMart commands nearly 60% market share of the online declassified space, making it the largest player in the industry. IndiaMart's website features a staggering 98 million product listings from 56 different industries, making it one of the most diversified marketplaces in India. They boast a whopping 7.5 million supplier storefronts, 200,000 paying subscription suppliers, 95 million live product listings, and more. The company operates on a subscription-based revenue model and RFQ quota. Did you know that their top 10% subscribers generate a whopping 47% of the revenue? As of financial year 23, the company has made strategic investments in equities across various sectors, from bison to fleets. Let's do a basic financial overview. IndiaMart Intermesh, with a market capitalization of 15,864 crore, operates with a current stock price of 2,591. Price to earning ratio is 48.44, lower than its sector pay ratio of 67.31. Stock price rose 16.12% and underperformed its sector by 1.06% in the past year. Debt to equity ratio is 0 as the company is debt-free. Return on equity, ROE, for the last financial year was 13.78%. Promoter shareholding decreased by 0.01% in the most recent quarter to 49.21% with zero promoter pledges. Let's discuss the strengths and weaknesses of the company. In terms of valuation, the company appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it might be a good time to consider the stock as it is not in the overbought zone. Over the past 8 quarters, the company has consistently achieved growth in sales, reflecting a positive trend in its financial performance. Despite not having a high trendline durability score or Piotrowski score, the company stands out with its low debt, indicating a favorable financial position. Moreover, the company demonstrates a positive net cash flow and a continual increase in cash generated from operations, reinforcing its strong financial health. FII and DIIs are actively buying the stock. It outperforms the industry in providing better long-term returns. Furthermore, the company's historical PE suggests that the stock is currently in the buy zone, and valuation score does not signal overall affordability. Next stock from our list is from the glass sector. This stock holds 70% market share in automotive glass. I am talking about Asahi India Glass Limited. This stock is India's leading integrated glass solutions company. Established in 1984 as a joint venture between the Lebru family, Asahi Glass Co. of Japan, and Maruti Udyog Limited, AIS has become a powerhouse in both automotive and architectural glass segments. With the acquisition of Float Glass India in 2002, it became Asahi India Glass Limited. AIS operates under two business units: AIS Auto Glass, specializing in laminated and tempered glass, and Float Glass, focusing on architectural and consumer glass. AIS dominates the Indian auto glass market with a staggering market share of over 70%, supplying to various segments, including passenger cars, commercial vehicles, railways, and earth-moving vehicles. In the architectural glass market, AIS is the second largest producer in India, offering a wide range of products. AIS's revenue mix is diversified, with 54% from automotive glass, 41% from float glass, and 5% from other sources. AIS is backed by AGC Inc., Japan, a global leader in glass manufacturing with a significant market share in both floating glass and automotive glass segments. AIS has maintained strong relationships with leading OEMs in India, supplying auto glass to major players such as Maruti Suzuki, Hyundai, Honda, Tata Motors, and more. AIS has been rated the best Indian company in glass and ceramics category by Dun Bradstreet and honored with the Superbrand status. Let's do a basic financial overview. Asahi India, with a market capitalization of 14,254 crore, operates with a current stock price of 586 rupees. Price to earning ratio is 41.18, higher than its sector pay ratio of 35.54. Stock price fell 5.07% and underperformed its sector by 49.26% in the past year. Debt to equity ratio of 0.65 is less than 1 and healthy. Return on equity, ROE, for the last financial year was 17.58%. Promoter shareholding is at 54.24% with 3.96% promoter pledges. Let's discuss the strengths and weaknesses of the company. In terms of valuation, the company appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it might be a good time to consider the stock as it is not in the overbought zone. The company has seen consistent sales growth in the last 8 quarters. The company exhibits a positive trendline durability score, indicating its robust performance. Moreover, it boasts a favorable Piotrowski score, signifying strong financial health. Additionally, the company maintains a low debt level and demonstrates a robust return on equity, ROE, contributing to enhanced shareholder value. The positive trend continues with a healthy net cash flow and increasing cash generation from operations. Furthermore, institutional investors, including IBI, YPI, and DIIs, are actively buying the stock. However, despite these positive aspects, the company falls short in terms of long-term returns compared to the industry, and its historical price-to-earnings, PE, and price-to-book value, PBV, ratios do not align with the buy-zone classification. Moreover, the overall valuation score suggests that the stock may not be considered highly affordable at present. The 7th stock from our list is from the recreation sector. This stock is one of the largest operators of amusement parks in India. I am talking about Wonderla Holidays. Wonderla is set to unveil a stunning amusement park located 45 kilometers away from Chennai, spanning across 62 acres. This is a Disney-level amusement park. Wonderla Holidays is the force behind 2 incredible amusement parks, Wonderla Kochi and Wonderla Bangalore, with a third, Wonderla Hyderabad, on the horizon. Wonderla also operates the luxurious Wonderla Resort in Bangalore, offering 84 luxury rooms, banquet halls, a multi-cuisine restaurant, and more. From eco-friendly tourism projects to innovative rides, they have been recognized by various tourism boards and industry associations. Founded in 2000 by promoter Kochosef Chittilapilli, the journey of Wonderla started with Weekland in Kochi and expanded to Bangalore in 2005. The revenue breakup includes Bangalore contributing 40%, Hyderabad 29%, and Kochi 31%. With plans for a park in Andhra Pradesh, a new park in Chennai, and an asset-light model in Odisha, they are taking the thrill nationwide. Plus, they are eyeing opportunities in Madhya Pradesh, Punjab, and Goa. With new leadership, including Mr. Dhiran Chaudhary, Wonderla is gearing up for the future. They have received the green light for their Chennai project. Let's do a basic financial overview. Wonderla Holidays, with a market capitalization of 5,205 crores, operates with a current stock price of 920 rupees. Price to earning ratio is 30.29, lower than its sector pay ratio of 62.68. Stock price rose 142.77% and outperformed its sector by 117.33% in the past year. Debt-to-equity ratio of 0 is less than 1 and healthy. Promoter shareholding is at 69.72% with zero promoter pledges. Let's discuss the strengths and weaknesses of the company. In terms of valuation, the company appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it might be a good time to consider the stock as it is not in the overbought zone. The company has demonstrated remarkable performance over the last 8 quarters, achieving consistent growth in both profits and sales. Additionally, it boasts a high trendline durability score, indicating robust and enduring operational strength. The Piotrowski score is also impressive, reflecting strong financial health. With low debt, positive net cash flow, and a track record of generating increasing cash from operations, the company showcases a sound financial position. Shareholder value is enhanced through a robust return on equity, ROE, contributing to its appeal. Moreover, the stock is favored by institutional investors, as evidenced by continued interest from EBI, EPI, and DIIs. Furthermore, the company has outperformed the industry in delivering better long-term returns. However, it falls short in meeting the buy zone criteria based on historical PE and PBV, suggesting caution in these aspects. Despite these considerations, the company's overall affordability, as indicated by its valuation score, is not entirely favorable. The 8th stock from our list is from the chemical sector. This stock is a powerhouse in the specialty chemical industry. I am talking about Vinti Organics. Established in 1989, Vinti Organics Ltd has become a prominent player in the manufacturing of specialty organic intermediaries and monomers. Vinti Organics specializes in a diverse range of products, including specialty aromatics, specialty monomers, butyl phenols, and other specialty products. These products cater to various industries, such as water treatment, construction, paints coatings, personal care, and agrochemicals. What sets Vinti Organics apart is its market leadership. With a 65% plus market share in the production of ATPs and IPP, the company stands as the only backward integrated manufacturer with its own isobutylene manufacturing unit. In a strategic move, Vinti Organics approved a merger with Viral Additives Private Limited in 2021. Vinti Organics boasts an impressive clientele, including industry giants like Chemtol Inc., BASF Corporation, Mitsubishi Corporation, ASNEP, and Dow Europe GmbH. Their global reach extends to countries such as the USA, Australia, China, Germany, and more. The company's revenue breakdown shows that the majority, around 96%, comes from the sale of products. With exports contributing to 68% of the revenue, Vinti Organics demonstrates a robust financial performance. Let's do a basic financial overview. Vinti Organics, with a market capitalization of 17,530 crores, operates with a current stock price of 1,706 rupees. Price-to-earning ratio is 42.91, lower than its sector pay ratio of 95.45. Stock price fell 20.53% and underperformed its sector by 22.82% in the past year. Debt-to-equity ratio is 0 as the company is debt-free. Return on equity, ROE, for the last financial year was 20.64%. Promoter shareholding is at 74.06% with 0.66% promoter pledges. Let's discuss the strengths and weaknesses of the company. In terms of valuation, the company appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it might be a good time to consider the stock as it is not in the overbought zone. The company has demonstrated consistent profit growth over the past 8 quarters, indicating its financial stability and performance. Moreover, it has exhibited sustained sales growth during this period, reinforcing its market position. With a high trendline durability score and a robust Piotrowski score, the company reflects strong fundamental health and operational efficiency. Additionally, its low debt and positive net cash flow contribute to a favorable financial profile. The company boasts a strong return on equity, ROE, enhancing shareholder value. Furthermore, it consistently generates increasing cash from operations, showcasing its operational strength. The stock has garnered attention from EBI, EPI, and DIIs, signifying investor confidence. While it may not have outperformed the industry in long-term returns, the stock is in the buy zone according to its historical price-to-book value, PBV. However, its valuation score suggests caution, indicating that overall affordability might be a concern. The ninth stock from our list is from the packaging sector. This stock is the second largest glass container company in India, with approximately 20% market share in the organized glass packaging sector. I am talking about AGI Greenpack Limited. The company is engaged in the manufacturing, selling, and trading of building products and packaging products. In 1972, the company entered the glass bottles and containers manufacturing sector through the acquisition of Associated Glass Industries Ltd. The company underwent a name change to Hindustan Sanitaryware Industries Limited in 1969 and, eventually, to Hasil Limited in March 2009. Recently, it demerged its consumer products and retail business into a new company called Somani Home Innovations Limited. When it comes to packaging products, the company has a diverse portfolio, including glass containers, specialty glass, PET bottles, and security caps closures. A whopping 89% of their packaging products revenue comes from glass containers. Within this, 75% is attributed to alcoholic beverages, 19% to food and beverages, and 6% to pharmaceuticals. The company boasts an impressive clientele, with over 500 diversified institutional clients, including major names like Abbott, Coca-Cola, Glenmark, Bacardi, and more. They have expanded its horizons by venturing into the cosmetic and perfumery segment, tapping into one of the most profitable market segments in the country. Let's do a basic financial overview. AGI Greenpack, with a market capitalization of 6,033 crores, operates with a current stock price of 932. Price-to-earning ratio is 21.48, lower than its sector pay ratio of 62.68. Stock price rose 195.14% and outperformed its sector by 169% in the past year. Debt-to-equity ratio of 0.46 is less than 1 and healthy. Return on equity, ROE, for the last financial year was 16.28%. Promoter shareholding is at 60.24% with zero promoter pledges. Let's discuss the strengths and weaknesses of the company. The company's valuation appears to be overvalued compared to the market average, with the current price exceeding its intrinsic value. However, it is a good time to consider the stock as it is not in the overbought zone. The company has demonstrated consistent sales growth, positive net cash flow, and strong returns on equity over the last 8 quarters. Additionally, it boasts a high trendline durability score, a high Piotrowski score, and low debt. Shareholder value is evident through its robust financial indicators, and it is generating increasing cash from operations. Furthermore, both FPIs and DIIs are actively buying the stock, reflecting confidence in its performance. The company outperforms the industry in long-term returns, and its valuation score indicates overall affordability. However, the historical PE and PBV do not place the stock in the buy zone. The 10th stock from our list is from the ethanol sector. This stock holds 70% market share in biofuel production. I am talking about Praj Industries. I have already done a detailed analysis video of this stock. Click the link above to watch. Remember, always conduct thorough research before making investment decisions. I hope you found this video informative, and subscribe to our channel for more informative videos.